Hello and welcome to this week's instalment of Nucleus Investment Insights. This week we dive into what promises to be a lively debate about the future of Australia's favourite asset class, property. As the nation slowly stirs from its COVID hibernation and normalcy slowly returns to the Australian way of life, the question remains, will rampant demand for Australian property roar back to life, or will the economic impacts of isolation be enough to finally topple king housing from its reign as one of Australia's darling investment classes? Here to present the bull case, we have Dr. Cameron Murray. Cameron is an economist and consultant who specialises in property markets, environmental economics and corruption. He's a postdoctoral researcher at the University of Sydney, blogs on fresheconomicthinking.com and is co-author of The Game of Mates. In the other corner of the ring, representing the bear case, we have our chief economist, Leith Van Onselen. G'day, Leith.
G'day, Tim. G'day, everyone. How are you?
And our head of investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
Wonderful. And just a quick reminder before we touch gloves to subscribe on YouTube and click the notification bell to be notified of when we go live or have a new webinar to watch. And follow us on your preferred podcast platform. And for those listening in live, head on over to nucleuswealth.com/webinar and leave any questions in the chat box video below to have them answered along the way. Let's jump into the agenda now. So we're going to, of course, kick off with the bull case covered by Dr. Cameron Murray. We'll then roll into the bear case in rebuttal, I guess, covered by Damien Klassen and Leith Van Onselen. And then we'll then roll into the general discussion/debate, cover off on any viewer questions remaining, and of course work this into the investment implications on how we work these themes into the portfolios at Nucleus Wealth and the MB Fund. So, who'd like to go first?
Yeah, I'll go first if that's all right. It's going to be an easy debate, this one. No, I'm joking. A little bit like the CoreLogic Index. Cam's unfortunately gone down. So we don't have a bull case at the moment, but I'm sure that'll come back online. Look, I've been, myself and, pretty much, I guess, most commentators have turned a little bit bearish on Australian property, principally for obvious reasons. We've just had the coronavirus shutdowns, hit from mid-March, and this is shaping up as the biggest economic shock for the Australian economy since the Great Depression. Although the official unemployment rate's only risen to 6.2%, the true figure is a lot worse than that. With effectively, once you factor in JobKeeper and you adjust out, obviously, the massive fall in the participation rate, unemployment in Australia is probably running closer to what would be double-digit figures at the moment, which is incredibly high levels. We've also got, obviously, hugely falling incomes because, obviously, more people are unemployed. You've got businesses have been shut down and across a whole raft of areas. And then, so that's obviously one of the key things weighing down that I think is going to weigh down property values going forward. Massively rising unemployment, falling incomes. The second big bear case factor, I guess, is collapsing immigration. So, as we know, the last 15 years, Australia's run a turbocharged immigration, which is added to housing demand. So Australia's effectively grown by about roughly 400,000, give or take, per year over the last 15 years, which is kind of like adding a Canberra to our population every year. However, because of the travel restrictions and the fact that our international borders shut and will likely remain so for a long time, the official projection is for immigration to fall by about 85% this year and possibly in the next year. So that'll remove a whole bunch of housing demand from the market. And that's why we're seeing the Housing Industry Association, the Property Council, and the likes like that, basically in panic mode, arguing for taxpayer stimulus, for tax breaks, for immigration to be returned as quickly as possible to basically fill that hole. At the same time, because we've got less overseas arrivals, we've got literally thousands of Airbnbs and short-term rentals being returned to the rental market at the same time as this huge pipeline of apartments is being completed. So we're seeing rents begin to fall quite sharply and rental vacancies surge, which is just another sign of oversupply. We're also hearing anecdotal stories. They're only anecdotal at this stage, but I've got them from a lot of different sources like Louis Christopher, Catherine Cashmore, and there's been some other media reports of banks tightening credit standards. And this makes sense because obviously with rising unemployment and more business failures, etc., banks have been a lot more, or starting to become more frugal on what's on the size of the loans they write and who gets credit. And as we know, the Australian housing market for a long time has been driven not just by population growth, but more importantly by easy credit. So if you tighten up those credit standards, that means that there's less credit available, and that other things equal should point to falling house prices. And I guess the final nail in the coffin is that we won't get tailwinds from falling mortgage rates. So basically, after every other housing correction we've had over the last 30 years, the official interest rates have fallen, and that's lowered mortgage rates and provided tailwinds, which has then fueled the recovery. But this time around, mortgage rates are pretty much the lowest level they're likely to ever get to. I mean, they might fall marginally more, but we're effectively at the lower bound for interest rates. So that means that unlike prior corrections, the RBA can't come to the rescue and lower mortgage rates and then obviously juice demand again. And on top of that, the banks are given, I think, around a quarter of mortgage borrowers 6 months for relief by basically giving them 6 month moratoriums on their mortgage repayments. Well, that's going to come to an end at some point, which is going to weigh on mortgage holders and spending, etc. And at the same time, the massive subsidies from JobKeeper and JobSeeker, which are estimated to provide around $130 billion of stimulus, or 25% of GDP to the economy, is scheduled to end at the end of September. Now, those are likely to be rolled over a little bit, but that's going to leave another hole for the economy, which ergo means house prices should be under pressure. So that's basically the bear case. Why I believe the housing market's cruising for a bruising. How far it falls, who the hell knows? But I just can't see any real positive signs for the housing market right now.
Leith, we just had a question come in from a viewer. Can rentals fall by 50% with a lot of question marks? Surprise?
Probably not.
Yep.
Probably not 50%. I mean, honestly, when we talk about all this stuff, we are really just guessing, making educated guesses. So nobody knows for sure what can happen. But 50% seems, far too extreme in my view. But we could see a situation like Perth. So Perth basically had 20% rental reductions over about 5 years after the mining boom ended there, and Perth's unemployment rate kicked up to, I think, a peak of about 6 point something percent. And obviously net migration there collapsed. So Perth's actually a pretty decent example of the kind of factors, headwinds that the Australian economy could be feeling. And, again, rents fell there about 20%. Actually, house prices fell in Perth, peak to trough by about 22% over about the same period. So Perth's probably a decent, I guess, barometer of what could happen. I'm not saying it will happen, but it could happen. It's probably, given it's a, fairly major sized city, it's probably the best indicator, I suppose, if you want to look at something empirical.
Yeah, sure. And obviously immigration is a huge component of property price, particularly Melbourne and Sydney. What's your view on, when are the borders going to be open, and and how long is it going to take before immigration can provide that positive push? Again,
look, I'd be surprised if it got back to the same levels it's been running at.
Right.
But I mean, who knows? But definitely the lobbyists definitely want the spigots to open back up. And in fact, the New South Wales government today has just come out saying they want to bring back international students with a 4-week quarantine. So perversely, they want to allow international students to come in before Australian citizens are even allowed to travel around the country or travel offshore. But so there certainly will be the lobbying pressure to do it. I just think the reality of this virus, which is likely to stick around for ages, and also the fact that, do we really want to be ramping up immigration when we've got very high unemployment and massive labour market slack? Like the whole notion behind the immigration program was skilled migration to fill labour shortages, etc. We all know it's baloney. But that was the argument. How can you make that same argument when you've got the unemployment or effective unemployment, if it's not showing up on the statistics, at an incredibly high level, income's probably going backwards, and massive labour market overcapacity left, right and centre? I just can't see the electorate being very happy with that situation. The whole mass immigration program was on the nose anyway, and I think now, given the situation we're in, it's going to stay lower than it has been for quite some time. I mean, how long's a piece of string? 3 years' time, we might be back to where we are, but over the immediate term, or the near future, I think immigration is going to be way down, and that'll obviously weigh on the housing market.
Yeah, that's just to jump in on both those two questions as well. I think I'll start with the immigration side. It is important to note that a lot of the Australian immigration, where it ticked higher, was during the mining boom and during the when we had the financial crisis, and Australian and the mining boom sort of picked up, and so Australian employment was still kept quite high. So I guess the way we look at employment is in a few different ways. One is the sort of student trade where you bring students over and then you hire them relatively quickly. But the other part is when is people who are actually coming to Australia because they've lost their job wherever they've lost it, and they're looking at the Australian market going, well, unemployment's still relatively low over there. This is what they're saying during the financial crisis. So yeah, we'll move to Australia. Or if I'm an Australian citizen who's just lost my job in the UK or the US, maybe I'll come back home because unemployment's still relatively low in Australia, which is different to if people are thinking about coming to Australia and we're looking at sort of massive unemployment rates. It's pretty hard to come to a country and say, well, yeah, say the unemployment's sort of over 10%. It's a lot harder to say, yeah, I'll pack up all my bags, bring my whole family over, and find a job in this country that where I'm not quite sure whether I get a job or not. So that was on that side. The other one I thought it's interesting to note, just on that whole question about how far can rents fall, is you got to remember as well in terms of this is that there are that very few rental contracts. Most rental contracts are sort of at least 6 or 12 months, and so if somebody's already in an apartment, it's unlikely that the landlord's got to turn around and offer them to drop their rent 50%. It's more when you get the turnover that you get big falls in rental amounts, and so they take a long time to come through because you've got whatever it is, 90% of the renters or 95% of the renters don't turn over in a year, and so their rents stay relatively constant, and it's only sort of the new ones or the that are coming through. So I think there's while you might see some big headline falls in individual apartments and ones like that might look like they're somebody who used to rent it out as an Airbnb and now has had to put a tenant in there might be seeing a 50% fall in their income in terms of what they're getting, but we're expecting that if the rental declines will take a while, they'll take years to come through, even in a weak rental market, just because of existing rental contracts that don't get changed.
And it's also going to be very location specific as well, because for example, SQM Research releases their vacancy data, and that's shown that in inner city areas like Melbourne and Sydney CBD, rental vacancies have shot up massively into double digits. And that's primarily because the CBDs are the prime landing point for migrants and also for international students, so they'll obviously get hit harder than other places. So yeah, there are also locational factors as well.
And
I think I'm back, by the way, guys. Can you hear me?
Cam, there you go.
Hey, listening in. Sorry, a bit of a technical failure here.
Yeah,
that's okay.
Lee's been casting aspersions about something about the daily the Rismark daily price index going down, and it's a bit like he's casting aspersions about that being for nefarious reasons, and you're dropping out just as you come to give us your bull case.
Yeah. Speaking
of which, I can disagree on the index. I guess my view is that a daily index on a slow-moving asset like this, very heterogeneous, was always, a bit of a stretch, and probably best ignored most of the time.
Yeah,
Fair point.
So I think, if turnover's collapsed for the last 6 weeks, it makes sense. Your method relies on churning through this data and adjusting for all these characteristics of houses. So it's neither here nor there for me. It'll be back as soon as turnover picks up.
Yeah, I mean the other thing I'd sort of comment on that one as well is, as much as they say like it's a hedonic index they call it, and so that they will adjust for changes in number of bedrooms and all that type of thing. But what they've got no idea is how much people spent. So somebody buys a place for whatever $600,000, spends $300,000 and sells it for $800. So you've gone from 600 plus your 300 you've spent, and you've only managed to sell it for 800, so you made a loss. But as far as the hedonic index is concerned, as long as you haven't changed your number of bedrooms, that's a 33% gain from 600 to 800.
I'm sure it's a bit more sensitive than that to the condition and things like that, and that will wash through with the averages through the market anyway. I don't have any real concerns with the index, except it can't be revised, and so it has to be sort of changed each day. Which can lead to various types of drift and things, but I think it's no big deal.
Yeah, no, Damien was only joking, by the way. I barely even mentioned it. No, it's true. It's true.
Go back to the tape, Cameron, and listen. Anyway, why don't you jump in and give us your bull case?
Yeah, welcome to the show, Cam, and let you swing in.
Yeah, all right. So maybe I'll just start where I agree with Leith on this, and that is the bank's willingness and capacity to lend to willing borrowers in the next 12 months. To me, the whole case really depends on this and almost nothing else. So that's where we agree. So I've got sort of three sort of areas that to me point to not a large or sustained downturn. Obviously, a short downturn is quite possible. So the first area is investor lending. And investor lending in Australia has been in the doldrums for 3 or 4 years. And in my view, it's investors that are really the price setters in the housing market over the cycle. So when investors disappear, things go down. Now, first home buyers can sort of come in and upgraders take up a bit of slack. But it's really the investor lending that allows the low interest rate settings to wash through the market and set prices. So look, it's been low for 4 years, and my view is that after things are low, they go up. They don't stay low for 4 years and then all of a sudden go negative. So that's my first sort of area, investor lending, and the thing that I think a lot of people are missing with the argument that low interest rates won't save housing again is that for investors, the low interest rates have only just begun since sort of the October, November last year. After the Royal Commission, there was a lot of the lower interest rate settings were passed through to first home buyers, but investors were treated as much higher risk. If you look at the RBA new investor lending, and if you go and do any mortgage calculators, you'll see that in the last sort of 8 or 9 months, the new investor interest-only loans with a 3-year fixed rate have dropped from over 4% to under 3%. And that, in my view, hasn't washed through the market yet. And that's a 25+% decline. And if you're just capitalizing at that 25% plus lower interest rate, then you're going to get a huge interest rate increase, a huge price increase as that washes through. It might be different in Melbourne where prices have still been rising, but in Brisbane, Adelaide, I think Perth's probably at a bottom now. Maybe Sydney even, that stuff has to wash through. The second main thing that I think supports the bull case is what I would call an oversized stimulus. We've injected so much money into the economy. We've allowed people to take out $9 billion from their super and reallocate it wherever they like. A lot of that's not going to be spent, and it's going to be saved in some form, and that could be used to leverage into housing. And I think the other thing we forget with the economic fallout of the coronavirus is that it doesn't really matter what happens to unemployment. It doesn't really matter all that much, that some people are reducing hours, because you only need an extra 1 or 2% of people to start deciding to buy houses and use this new lower interest rate to really affect the price, because the price is set at the margin. 90% of people, or something like 95% of people don't buy a house in a given year. So it doesn't matter if those 95% lose their jobs or whatever. If that 5% that's active or potentially active has just got 20 grand from their super, 10 grand or 20 grand from the government because they run their surgical practice or their legal practice through a company, they're gonna be just cashed up and need to do something with their money. And they might be hesitant about the share market with all its volatility. And if you can go to Brisbane or Adelaide or something and get an investment property yielding 4% and borrow at 2.8, you probably will do that. So on the oversized stimulus, I also think that we're going to get a bit of a step response. I think we'll be surprised how quickly things correct, and then they'll correct quickly, then slowly. And I think that quick correction period is really going to improve a lot of the confidence that people have to get back into property. So that's my view there. And the third sort of area, I hope you guys can all still hear me.
Yep. Yeah, go ahead.
Okay, good. I'm a bit paranoid about the sound here and the reliability. The third main area is you got to look at historical patterns of cycles. Essentially, things go up and down, and things have been down lately. And after they go down, they go up. So, for example, you take a look at the posts at Macro Business from early and mid 2012. Everyone was saying, "Oh, this is a big shock. The mining boom's over," or whatever the case was at the time. It was a very similar vibe to today. Lots of the same issues. Unemployment was rising, and then continued to rise from 5% to 6.3% for the following 3 years. It was a really not a great economic time. But as you will recall, prices boomed the next 3 years rapidly, like 40 or 50% in Sydney and Melbourne. Even prices in Ireland came off their bottom that year. So it was really the resurgence of a global trend that I don't think is over yet, and that sort of financial momentum, despite this crisis, this COVID, response, economic shock, disrupting a lot of stuff, that financial momentum I feel is still there. If you look at the US, new mortgage applications have recovered in the last few weeks to only be down like 2 or 3% on the year. So there's a real potential for this cycle to continue, in my view. See it all of a sudden turning around now with the biggest global stimulus in the history of humankind. Yeah, sure, certain sectors are going to be badly affected by employment, but as I said, I think there's going to be a step response of people rapidly jumping into other areas where this stimulus is being spent and expanding those parts of the economy. If you look at China, for example, they've got a bit of a housing cycle ready to pick up again. And I guess my case here is that the last 3 years were already an adjustment period. We actually already had it. We saw Sydney prices fall almost 15%. We saw that cycle get bailed out by the low interest rates. We saw people stop buying cars the last 3 years. Okay, that to me is an argument that we've made a huge adjustment already. all these things that we're now panicking about and looking at the data, they've already happened. Now I might be 12 months ahead of myself. Maybe this year's going to, be some surprise falls, but I think there's a case there. Actually, there's one more area I might want to talk about. Just the general balance of supply and demand for buying and selling houses. Who's a willing seller and who's a willing buyer right now? If the China cycle's picking up again, I can see foreign buyers coming back. You can see Cameron Kusher at realestate.com. He's reporting increased search interest. I know in Brisbane locally that I've seen queues outside display homes or display apartments last weekend. Once things opened up, even my mum's selling her house. And after weeks of nothing, 10 inspections all of a sudden on the weekend. So some of the stock that was sitting there is clearing out. I think most sellers are patient. I can't see a case for a lot of panicked sellers with loan holidays, stimulus, the ability to refinance at lower interest rates, all that sort of stuff. Sorry, truck in my street. And turnover can be extremely low. Sort of the market can be stabilized, a very low rate of turnover because so few sellers need to get out for any real reason. And if prices start rising, that's going to rescue them even more. What that really means is that you can affect prices with very, very few buyers now. Very, very few buyers who can leverage up much higher, fueled by these low interest rates, which brings me back to the point that I agree with Leith on, is that banks' willingness and capacity to lend at these low rates in a way that they have the last 20 years. To sort of wrap it up, on the population effects and the Airbnb, if you just look back historically, most housing booms had falling rents. Because once the boom gets going, it's associated with more construction, outsized construction through the cycle. I'm not really worried about rents. If rents fall 15%, it's almost insignificant compared to a decline in interest rates, from 4.2 to 2.8, something like that. It's almost a nothing in many ways. And on the effect of population on prices in the last cycle, I like to say it's not the people, it's their bank accounts and their financial access that is bidding up housing. Because if those people all come in and they're not earning too much money, they're limited with their willingness to pay. No matter what they leverage, it doesn't matter. They can't be the highest bidder at an auction. So my view is that the population effect on prices is mostly the financial effect of the types of people who have money that they want to sink into Australian real estate. Per se. And we can certainly have booms with low population growth. The 2001 to 3 boom was not a historically high population growth period and was the biggest boom we've had since the 80s. So I think there's that. So what I would say though is a lot of the things we're talking about, this super cycle, bottom in interest rates, whatever you want to call it, the lack of ammunition of the central bank, that's going to hit at some point. And I guess my view is that's a sort of long-term concern, sort of more than 10 years out, because that's going to interact with the demographic super cycle we have. Essentially, the baby boomers that own all the houses, or disproportionately, they're all going to die off. In a cycle with low interest rates that can't fall any further, and their children, the baby boomers who own more houses, their children also own more houses, typically, and they're going to inherit money or houses in their 50s when they don't really need it, and they'll have to start selling those to cut up their inheritance. So I think that's a long-term risk, and it's going to see a deflation of the last 30-year trend, but I definitely see between now and then one or even two cycles possible. What do you guys think? Have I convinced you?
No, but I've got lots of questions. I think there's some interesting points. Right. Yeah. So let's jump back to a few of them. So I might start with the oversized stimulus part. So I guess what I'm interested to hear is I sort of think about the main issue for say houses as being is not so much the stimulus, but not so much the absolute level, but it's more the distribution. So I guess if you've distributed it so that people who wouldn't have otherwise bought houses aren't really getting any money, and people who would have bought houses are getting lots of money, then you can sort of see where that distribution can lend to growth. And there is there's definitely an element of that I think is true in terms of the there's a lot of say white collar workers who managed to work from home, didn't lose their jobs, and because they're not spending as much money and they can't do overseas trips, they're accruing more money. But the problem is at the other end, where a lot of blue collar workers and that bottom end of the property ladder, where they're the most likely to have lost their jobs or to be on this job keeper or job seeker, and they're not going to get a loan, or they're not going to be able to lend, on that basis. And so I guess it's the point about, do you think the stimulus that's come in is greater than the economic shock that we're going to see in terms of the demand hit?
Yeah, quite possibly. Quite possibly. And those distributional points you make are right. I guess my main point is that it's really about the investor appetite determining the price effect now. You could have 0 new homeowners active in the market, and just the pure yield on the 2.whatever% interest rate is going to become very attractive.
That said, though, the rental yield is the lowest it's been in history, and we know rents are about to fall. So the rental yields are going to fall even further.
Rents can't fall very much. They can fall maybe 5%, by the end of the year, 10% in some areas. That's like less than you factor in for vacancy. That's sort of, it's relatively insignificant in the grand scheme of things. And if you look historically, typically people buy with a yield that's around half to 3/4 of the interest rate. So, even if your yield is 1.5%, if there's some sort of positive growth there, I feel like people are going to jump on it.
Maybe, but also with high unemployment, obviously investors can't negative gear when they don't have a job. And
they're not. That's the thing. They're not the people, right? They're just not the people who invest. So the last, we've had unemployment at 6 to 8% and huge house price growth. Like 2012 to 2013, 6.5% unemployment. Yep. It was the record year we've had since 2002 or 3. And even in that period, we had pretty high unemployment.
Yeah, but with falling unemployment.
I think it's the momentum, right?
Massively falling interest rates then, which we're not going to see again.
Proportionally, it's roughly the same now, right? Like the interest rate effect on price is proportional. So if interest rates fall 1% from 4 to 3, that's a 25% decline. So the price effect is 1/3. 25 on 75. So a fall from 10 to 7 is roughly the same as a fall from 4 to 3, right? In terms of price effect, in the magnitudes. So that's how I would see it. Do you guys think that's not true?
But we're not going to see any more interest rate falls from here because they're already at the lowest. I know what you're saying, because you're saying they fell from like last November.
Yeah, that's right. But we're 75. So 75 basis points down for ordinary ones, and so investors may be down 1.25%. Is that so?
Yeah.
It's an interesting. Yeah, look, but on the unemployment side, and that's probably the part. So but really, what we're arguing is the fall in interest rates that we've already seen going to overwhelm what we've seen on the unemployment side? I guess.
Also availability of credit. We can't forget the availability of credit, which I think is the biggest threat.
I think. Yeah, so I think where we all agree is the availability of credit, because the interest rate effect is mediated by how accessible leverage is. So the interest rate can bind and limit the price, or at an interest rate, the number of people who can borrow at that rate will bind and limit the activity in the market and hence the price. So those who have access get essentially a surprisingly, they get a sort of economic rent because they have the ability to borrow where others don't at this super low interest rate. And on the unemployment, I think we need to just get out of our head that unemployment is in any way related to asset prices. It's just you got to think about think about a demand curve, right? The lower interest rate makes the demand curve for every single buyer move up vertically. Their willingness to pay, and that vertical movement is much more price influential than any sort of incremental horizontal movement from perhaps some potential buyers dropping out of the market or not because of employment, risk.
Yeah, but I think what I wanted to say on the unemployment side is I think you've only looked at one side of it. So you said, okay, well, on one side we've got, as I said, 95% of people don't buy in any 1 year, and so
more sales.
So whatever. So we've got a few people coming in. So you don't take too many out for loss. Too many people who are potential buyers don't come in. But on the flip side, there's a lot of people who already own houses, and it's the forced sales part, as Leith was saying. Yeah, his question is that's my big question is, as you said,
especially from the investor side.
It only takes 1 or 2%, as you said, to really get things moving at the margin, because prices really happen at the margin.
Yeah, that's right.
It doesn't take many. So, and it's still an open question, isn't it? So when does the moratorium end? Is it September? Were we talking on
yeah, it was about 6 months. So I'm pretty sure the bank moratorium finishes in September, and so does JobKeeper and the expanded job seeker. So
yeah, and so
we've got this sort of fiscal cliff, I guess.
Yeah, so it's an interesting question as to what happens.
Yeah, but I mean, think about who the potential sellers are. I mean, only a few % of potential sellers have bought at the recent highs, right? Almost everybody who's bought a house and owns a house bought prior to the last cycle. Yeah, only a few % bought in the last cycle, and they've already been rescued by a 25% plus decline in the interest rate, plus a mortgage holiday, plus access to their super, plus various things. So, I think you've got to sort of, there's still a very small group of potentially distressed sellers.
That's all you need, because if prices are set at the margin, you only need a small percentage.
I agree. But I'm just saying it's a small group as a whole. How many of them actually become distressed? Out of the small group will be an even smaller group.
The reason why I'm suspect on that is because, I mean, this is obviously all anecdotal, but I know there's 2 properties around within about 100 metres of my house that have been sold by investors right now, because they're getting out because rents are crap and they've got job concerns. So I mean, I think there's going to be a lot of investors out there, and as we know, a lot of them are negatively geared even at these low mortgage rates, who are facing either the higher rental vacancies, declining rents, or job insecurity, who will have to sell their property. I mean, I don't know how big that number will be, but it'll be, it could be significant. And again, if prices are set at the margin, that could easily also have a downward impact.
Yeah. So let me be clear.
Ultimately, we don't know. Like, this is all just spitballing.
Look, I mean, that's right.
Just throwing out things.
Agree. And if you look, just watch the share market. The volatility is off the charts, and you've got to imagine that sort of uncertainty and volatility is in the minds of both buyers and sellers in the housing market right now. Some are desperate. Some see it my way. Some see it your way. And then we've got this interaction of that, and we just don't really know. But let me be clear: if all the property investors decide and panic and flood the market and sell and crash prices, I'll be a happy chappy. Like, it's great for me. That's like my dream, to have this sort of shock to the Australian psyche about housing. But my realistic side and my sort of, my acknowledgement of this political apparatus of house prices equal the Australian economy. Sorry, a bunch of trucks just decided to drive past my window.
Oh, that's right, mate. We can't hear them anyway.
So, I sort of, my rational side has decided not to bet against this at this point and just raise the case that, look, the property council today or yesterday, they called for a $50,000 first home or new home buyer stimulus plus a whole bunch of other stuff. Like, there's a pretty reasonable chance something like that will happen again in the next 12 months.
And that's where I will
you can't
agree
dismiss
with you,
that too.
I definitely agree with you, because you cannot discount stupidity when it comes to housing policy. As we know, we've experienced it time and time again in the last 15 years. Pretty much since the Howard government did the one in the early 2000s. We've seen these things rolled out, almost annually. So yeah, definitely don't discount stupidity, don't discount short-sighted policy. Basically dreamt up by Property Council, Housing Industry Association, and as we know, the Prime Minister is an ex-Property Council guy. He's a property guy, so yeah, he could easily roll out some sort of massive first home buyer grant. Any number of policies could come out.
Tax cuts.
Whatever. Definitely.
And think about it, in this crisis situation, it very well may be a political opportunity to bail out the banks in creative new ways, get them lending again. Something we've never seen before, but that has a flow-on effect that is really outsized compared to just the first homeowners grant. Look, so all those things are possible.
Absolutely.
Yeah, and I agree. And John Howard famously said, "No one's come up to me in the street and complained that their house price is going up." And look, that's the world we live in. I talk to a lot of politicians on both sides of politics, and when they think affordable housing, they think, oh, it should go up by 5% every year. 10% is a little bit fast.
John
and that's a bipartisan, entrenched policy position. And we're going to run out of ammunition for this through other factors. And I think the demographic cycle, the end of the interest rate cycle, all the things that we agree on there will be the end of that. But we've seen the willingness to use financial firepower in this crisis, a much higher willingness than I would have imagined. And just once someone decides to direct that towards the housing market, all bets are off. It's
yeah. And that was actually going to be my next question, because I thought that was actually really the basis of your argument, is basically that, look, we've got a government system, exactly what you said, government system that's relying on trying to get house prices. They'll come up with something, and that's probably, I guess the way I'm thinking about it at the moment is, so by giving all these bailouts and stopping people from getting kicked out of homes and all that type of stuff, we've tried to put the market on pause for 6 months, basically saying, okay, it's got nothing underneath it, but it's sort of in the Wile E. Coyote moment where the coyote's over ground, and now we're going to try and see if we can stick a bridge underneath it before he works out there's nothing under him. And see, that's the question I've got, is once we hit this end of the 6 month period, if there is a massive rollout, I sort of feel as if, well, yeah, you can probably keep house prices where they are, and maybe it's up a little bit over the next year or two if there's this huge push, but the reality is still a long way below, and so you're basically taking I guess what I'm saying, I wouldn't be telling people to rush out and buy houses right now, because you'd be saying basically maybe they'll levitate for a little bit longer, or maybe we'll be able to just keep throwing stimulus, and the government will be able to keep gearing up and basically taking little bits of money from everyone and pouring it into the housing market. I can understand, I can get that point, but I can't see it going up on any fundamentals, I suppose. And even the interest rate stuff you've talked about, I feel as if that's partly already in the market, but also it's a question of the people who are the forced sellers, I suppose. And that's where, as you said, right now they don't have to be forced sellers because they've been given all these holidays, and a lot of them are sitting on a lot of money. But if we're still looking at real unemployment or underemployment at whatever it is, we're 20% at the moment. Say it's still 15% by the time we roll out of in September, without a big support. I think there's a trapdoor opens underneath the housing market, and if they don't get to it fast enough, if we haven't got all these systems ready to roll and all their stimulus plans ready, I feel like I probably shouldn't even be saying this on a podcast in case they do, in case we've got politicians listening who are going, oh, right, I better get out and, start passing these things already. I feel as if you did get a 10% down movement quite quickly, and then they start trying to throw in all these things, by the time they get their first home buyers grants and all these other things going, it might be too late. Does that?
Oh, look, I see your argument. I would say that Australia is just so good at implementing first homeowners grants. They'll be announced and implemented in the same. We're just really good at that now. So, and people, just the experience people won't panic when they know this sort of stuff is being discussed. We already saw almost 15% fall in Sydney, and then that got boosted by the first home buyers, getting their low interest rates and getting in the market in the last sort of 18 months. So, there's obviously a tipping point, and when investors start to sell and it sort of cascades, that's what you're really looking for. And the question is, have we built enough of a scaffolding under Wile E. Coyote to get us to the other side? My gut feeling these days is quite possibly. I think the economic recovery is going to be surprisingly quick, much quicker than most people are discussing right now. Look, I haven't spent any money for 2 months. I'm ready to go nuts and binge on everything. And a lot of people who have a lot more money than me have spent nothing for 2 months and are going to binge. And, that works the other way. It builds confidence. It recycles through the money. Certain sectors are stuffed for at least a year in airlines and certain tourist areas and stuff. But, the Christmas holidays at the end of this year, no one is going to travel overseas, and that sort of 10 or 20 grand that a family might spend is going to be pumped into the local economy. All of it.
And
it's going to be packed. It's going to be absolutely packed everywhere.
That's the distribution argument,
holidays.
But don't you think that's where those ones are the sort of it's a wealthier person who's going to be saving that money, and there's going to be a lot of people at the other end who've had these jobs, who've been how many people have we got on JobKeeper at the moment, on JobSeeker?
6.3 million.
6.3. Like, I would have thought there's a lot of
job.
And the fact that it's already started talking about maybe we should finish it early and all that type of stuff. That seems to be there's going to be 6-point-something million people out there who, or maybe some of them have had a pay rise, but there's a lot of them out there who are actually going to be going, look, we're going to be sitting there going, I'm not going to rush out and spend because, I've just been through this period of lost my job and done whatever. I actually need to, pay off my credit card debt, and I need to, take a step back and
look, that's always true. But, out of those 6 million, didn't the Grattan Institute come out and say actually for half of them, they've got more money to spend than they previously had, which is sort of my outsized stimulus case. So, those are going to sort of balance out to a degree, those who have a little bit less and those who have a little bit more when you look at the aggregate spending effects. So I'm not, look, I definitely see the case that if for some reason adjustments aren't being made and, it's just this pool of people who just cannot get a job or get any income and really hit the brink. I mean, it could happen, but the way we've been just sending money to people left, right, and centre. I mean, look, what are there, 4 or 5 of us on the call here? Is anyone in a worse position to buy a house than they were 2 months ago?
Yeah, I don't think
we are the housing investor demographic for sure, right?
Yeah, but I'll counter that. My next door neighbour's just been made redundant. She's looking for a job. Next door neighbour, 2 doors down, both husband and wife, both one of them's on JobSeeker, one of them's gone on JobKeeper. Across the road, the same deal. Like there are a lot of people, and I live in an affluent area of Melbourne, and there are a lot of people in my street who are unemployed, who are struggling, and they're quite frankly quite worried about their financial future. And
I know there's a lot of places out there as well. A number of the big consultants agencies and a number of a friend in a healthcare industry as well, where they've just said they've gone through their workforce and said, okay, whatever it is, 20% of them are gone, and everyone else is taking a 25% pay cut. And so there's a lot of those out there as well, and not seeing. You're not going to see wage rises coming through over the next little while. So I think there's a bunch of winners who are going to save their money, and probably not. In the end, you're probably not going to rush out. You said you want to get out and spend, but you probably not, it's not like you're going to rush out and say, oh, okay, I'm going to eat breakfast, lunch, and dinner at a restaurant every day now.
No, but I might buy a house.
Yeah.
So so I take all your points. Just remember, a lot of that stuff though, we haven't had. Yeah, but just remember, we haven't had wage rises for what do we have, 8 or 10 years, and we had a huge property boom, biggest one ever in it. So, sure, it's going to dampen rents and whatnot, but just that pure interest rate effect washing through, I think, is so outsized compared to these other effects. I mean, if you look back at 2012 and you said, well, there's not going to be any wage rise in the future. Interest rates can't fall too much. Unemployment's rising.
2012, we were cutting interest rates significantly.
Yeah.
A little bit.
They were big. But that was massive. The RBA had said basically the mining boom's finished. We're going to build it. We're going to have a housing boom. Was basically what the RBA said.
Yeah, but proportionally, what was the lending effect on lending rates? Was it down a third? It was probably not quite as big in proportion. I mean, in nominal numbers, yeah.
Well, and what the numbers that you're talking about as well, they're if you need to take that 3 year out. But actually, sorry, can I jump to another point, because we've done this one a little bit. The other ones is the idea of the cycle part. So, and as you said, we've already in depressed earnings for a lot of these sectors. Doesn't that awfully sound though that to you that we're saying we're in a weak economy? We've got record debt levels, and now we're getting an external shock. And I guess I sort of feel as if you're saying, well, we're in a very weak economy. We've had this big external shock, so therefore the only way is up. Whereas I'm like going, well, if you're in a weak economy and you have an external shock, doesn't that mean you get a leg down?
I don't know. I mean, have you ever seen a cycle that was like came down, was pretty in the doldrums for a few years, and then all of a sudden crashed some more?
Oh yeah,
I mean, it's not. Yeah. What are some examples you reckon?
Great Depression. I think there's.
Look, I think those comparisons are a little bit, foolish. Like government spending as a share of the economy in the 20s and 30s was like 5 to 10%, and now it's like 33%. So just having that as a reference point, I think gets you on the wrong order of magnitude there. Like 20% unemployment when a third is employed by the government. It's pretty out there. You're saying essentially 1 out of 3 private sector employees, which is much, much worse than the Great Depression. Yeah. You've got to scale it all back by a third at least.
Yeah. Okay, but so let's not do Great Depression then. What about the US had their double dip recession in the 80s? They had their double dip recession where short-lived recovery and then back into the next sort of downturn from there. I mean that was So that's issues, lots of issues with I mean, there's lots of different things going on at that point, I guess. But I guess what I'm saying is it's not, especially for an external shock. I think you're right in that in terms of if you've been going through a normal economic cycle, and that's where I think we actually went through that last. It was a lot of Asia went through that last with SARS and all that type of stuff. They'd been through this economic cycle where everything was down following the tech wreck. Then you have this SARS, and so it didn't make much of a difference because you'd already hit the bottom. But I guess what I'm saying is I think unemployment was actually very low around most countries, and it's jumped up dramatically, and that's where globally I see that problem is globally we've been struggling to get demand for the last 10 years, and now we've got this huge shock to people's incomes and saying, well, governments will make up for that, and that's where I can't make the numbers add up to say it's going to be greater. I can see where in certain scenarios there'll be people who win out, and I definitely think rich people are going to do way better out of this than poor people. So,
I mean, rich people drive asset markets, so we should really only talk about rich people. Sorry, realistically,
unless you get enough poor people losing their jobs that you're starting to bring down the whole economy, and rich people, rich people who own businesses are going to be losing out of that. I guess that's where I'm worried, is not that I think that you're right in that the distribution is beneficial to it, but if rich people are going to start losing out as well because so many poor people aren't buying their products now, then that's where
Yeah, look, I definitely agree. That's a scenario. Look, I'm not saying that my scenario is 100% probability.
No.
Anyone who thinks otherwise is foolish. I'm sort of saying that, most people think this is a 5% chance, like it's pretty low or closer to zero than that. And I'm like, well, actually, I think it's closer to 50-50, and possibly even more likely given the political environment as well, that we can sort of all agree on, even if it's just a short cycle, it's 12 months down and then a couple of good years, 2021, 2022, it seems like we're all good, but actually nothing got fixed fundamentally economically. That was just a bout of overconfidence and low interest rates by a few overconfident investors, and the wash through of the aviation, tourism, small business sectors can't be ignored any longer. I mean, that's definitely a plausible scenario in my view as well. Like this year, it's very hard to know who's gonna, when all the desperate sellers show up. I've been looking around Brisbane to buy a house for a year, and nobody's desperate. Everyone's patient and waiting. And I guess my Brisbane example is a lot of people who bought 4 or 5 years ago are trying to get their money back now. We've sort of had that adjustment here, is what I'm trying to say. Like, there's been no boom to come down from in Brisbane, at least, and Melbourne's obviously a different case.
And Sydney, though, Sydney almost recovered back to its former peak. Obviously not in real terms, but
so Sydney, house prices are where they were 3 to 4 years ago in Sydney. So do you get big house price busts when they have just roughly where they were 3 or 4 years ago? I mean, that's pretty rare.
No inflation, so it's not that far below its peak in real terms. But can I just get back to the point? Like I think the fall in interest rates since it peaked last year, or since the last election, actually hasn't been that much. I've just pulled up the RBA's indicator lending rates, discount, variable discounted for owner occupiers. It's only fallen 16%.
No, but the fixed rates have come down further.
Go to fixed rate. Fixed rate investors, 4.2 to.
Yeah,
that's true. But the overwhelming majority of people go on variable. Like, variable dominates the market, so it's probably the fair one to look at.
Yeah, it might not when you get a third of the interest rate for fixing for 3 years off.
Yeah, okay.
And it's for new investors, that's I guess Cam's point is it's new investors get the discount. As you said, the existing ones, if they haven't done it, don't get that discount. But I think
but also just the other point is since the 2011 period, I think Cam also mentioned, mortgage rates come down almost 50%. So that's been an incredible headwind over that time. And I guess my point is the headwinds. Tailwind. Tailwind. But I just can't see much of a tailwind from here. That's all. I mean, the fall since basically the election last year was already fueled a bit of a price rise. Yeah.
The other thing I was going to ask Cameron on that similar basis, like we've got a housing calculator. Shout out to our you can get it from our website for anyone listening. Where what we do is we run a few different scenarios, and I sort of have this view that there's 3 big things that price. Well, there's four ways you can look at house prices. One of them is from an investor perspective, but I've actually thrown that out the window in terms of saying, you're basically hoping on, if you're investing in it, you're basically investing for capital growth. You can't invest in it as an income play on the basis. Yeah. So you're basically going. If I look about it and say, you've got your the weakest one is your wages compared to the actual price of the house, because people have to save a deposit. So that's one, but that's probably the weakest one, because that's not like an ongoing affordability. That's just can I get in? Then the 2 big ones I'm going is your mortgage cost compared to your wages. So, and as you said, because you want to be able to, can I actually afford it? And the other one's your mortgage costs compared to rent. And I think both those make a big difference. But I guess in terms of the mortgage cost to rent, for example, Sydney seems to go when rents compared to house prices reach 200%. So basically, it costs you twice as much to get a mortgage as what it does to rent. That seems to top out, and this is for Sydney houses, not units. And then at the lower end, when it's about 100%, so when it's basically the same cost to rent as what it is to get a mortgage, then that's where people then start to go, oh well, I will go and buy a house.
Yeah,
and so,
exactly.
And so from that perspective, I'm going, well, we were already pretty high on that. We're sort of 160 odd percent. Yes, we've had a fall in interest rates, and actually, I was actually thinking I'd probably need to factor in some of those 3 years into that calculation. So that'll help you bring you back to 130% maybe.
Mm-hmm.
But then the flip side is, rents are falling. So if you fall 10%, say 10 to 15, brings you back up towards that 150 again. It's not like a screaming. It's sort of basically middle of the band. It's not like a screaming buy or a screaming sell at that stage.
So I love that metric. I don't know if it was 2011 that I came up with basically the same thing. But obviously, the ratio of mortgages to rates to yields is essentially what I did. And yeah, that's exactly right. There's this 1 to 2 band, and when you can sort of, the rent covers the interest, then prices start going up, and when it's interest is twice the rent, so they start falling. I think there's the potential. Here's another scenario that I think is possibly even more likely than my generic increase prices case, is that Melbourne does a sort of Sydney in 2003 pullback. Doesn't really do anything, pulls back a bit, not panicked, while Adelaide, Brisbane, Perth, elsewhere catches up to this new low interest environment, low yield environment. So we sort of that's quite possible too, because the last cycle was really a Sydney and Melbourne one. And so that's also something to keep in mind, because in Brisbane you can get 4% yield houses every day of the week, and you can borrow at the same interest rate you can borrow in Sydney, right?
Yep. Well, I mean, mate, I've always thought Brisbane was incredibly cheap. I mean, I look at it from the eyes of a Melbourne guy.
In relative sense.
Yeah. Of course,
not in a actual overall house prices around the world sense.
Yeah, of course.
Yeah, but as an asset, right? Like, if you can buy for less than pay the interest and some of your mortgage for what the rent costs.
Then that's 4% before you get your before you've got all your fees.
4% gross real. Oh, but yeah. There's some costs obviously when you buy it, but you don't pay when you rent and whatnot. But
exactly.
As an owner occupier, right? It's quite attractive still. And the demand comes from all over the place, and in negative gearing always, just remember, it bails people out in the bad times automatically. Look, maybe that's the more likely scenario. I mean, Melbourne is just off the charts. The last cycle,
which probably explains why we have different views. Because I live down here in Melbourne, in the heart of the bubble, whereas you're living in Brisbane, which has been pretty relatively unaffected for a decade. So, and I do tend to look at the Australian property market through the eyes of Sydney and Melbourne, because it is 2/3 of the Australian housing market, those two cities pretty much. And they pretty much drive it anyway. But also I've got that inherent bias of being a Melbourne guy and seen Melbourne. So
I think maybe the case also about the foreign buying, the population change, and all that sort of stuff also is probably more concentrated in Sydney and Melbourne.
Absolutely.
I don't want to tell people what to do, but you've got to consider we're in a volatile period. You don't want to negotiate it with a single expectation. You want to have a suite of plausible paths in mind that you keep track of.
And I guess it's this question about how much do you want to bet on. To me, it's a question. If you think house prices are holding up, it's a bet on government intervention to keep you there. Because despite your ones, I guess I'm concerned the overall. If the overall fundamentals are, way less buyers, all these extra supply on from Airbnb, all those, you've got all these, you got all these negatives that are sort of coming in, and just demand, general economic demand, and unemployment. And then the flip side is basically what's going to hold it up is the unemployment, the interest rate cuts we've already had, and policy changes. Is that?
Yeah.
And then I guess an Australian ethos, I suppose, as well, in terms of house prices and money.
Yeah.
Oh, sorry,
Yeah,
and a distribution argument about rich
and the
people
distribution of the stimulus as well as property targeted stimulus.
Yeah.
And look, I have a sort of big picture view as well that 2020 was going to always be some kind of economic correction year. I mean, the global share markets were off the charts last year. Property had done this crazy recovery after the sort of 2017 adjustment in Sydney, for example. And I always sort of thought there must be some kind of correction. And I do wonder whether coronavirus is now an excuse for us not to reconsider the fundamental issues a correction would have. I'd go, there was nothing fundamentally wrong with what was going on in January or February.
Yeah, absolutely.
That is what we should get back to, because 100% of what happened was coronavirus. Whereas if it was just a surprise, sort of global share market downturn and a bit of a pop of the stock market bubble and a bit of a shock like that, there'd be a lot more fundamental, maybe that wasn't sustainable. Maybe we should dig into the balance sheets of these companies. Maybe we should be a bit more cautious and questioning. Whereas now we can go, no, that was the right price. Definitely, whatever, Facebook, Apple, Google, Tesla, you name something that was ridiculously high.
Very good. Look, gents, just in interest of time, and before this turns into Andy Bowen and Jack Burke, we might have to just have a quick run through some of the questions that we've had fired through. So thanks to everybody putting in your comments and questions along the way. I'm not sure if Cam is still there. It's going to be a pretty one-sided set of questions. Looks like we've a bit of a run through, but majority of them have been largely points. People just reporting back a little bit of anecdotal evidence as well, which has been great. Feel free for anyone who wants to check it out to head over to our webinar page. There was one actually just quickly just regarding the recent recovery in housing prices being a late cycle peak. And whether or not it could start tapering in late financial year 2022 onwards. Now, it was for Cameron. I'm not sure if his it might have blown up, but I'm happy to hand it over to you guys on your thoughts there. I think I know where the answer is going to go, though.
Sorry, can you restate the question? I sort of I was listening. I just didn't quite get the full gist.
No, that's all right. Do you see the most recent recovery in housing prices a late cycle peak? Which could likely start tapering in late financial year 2022. I think that was more for the bull side than the bear, but just some thoughts on prizes as a late cycle peak, perhaps, fellas.
Yeah. So had coronavirus not come along, I assume that's what it means. I mean, I basically thought that it was the housing cycle was probably going to run out of puff anyway. It would have run for another year, probably, maybe a bit longer, but just purely because interest rates are approaching the lower bound. So, this 30-year tailwind, which has seen mortgage rates fall from, what used to be 17% in the early 90s to basically under 4% now, it's got to the point where there isn't really much more room to fall. And once you hit that lower bound, you lose that tailwind. So, dwelling values would have continued to rise for another year, maybe 18 months. And then it would have got to this bit where everyone who was going to get in the market at those low rates would have gotten in, and then you sort of run out of, and then valuations become completely out of whack, particularly in Melbourne and Sydney, and then that drives the next downturn, whether that's a long period of stagnation or a little bit of a correction or whatever. But that's kind of what my thinking was. It's just that the whole coronavirus thing's obviously brought it to a head earlier, just because of all the economic impacts, et cetera, and all the stuff we've talked about, like the big collapse in immigration and et cetera, et cetera.
Okay, no worries. Thanks. Anything from you, Damien?
Hopefully answer the question.
Yeah, look, I think for me, is this, I guess, as a bit more of a summary on the section is, for me, it's what we've done is we've decided to fake it. So we've suspended as much as we can. in terms of not letting letting people take mortgage holidays, paying all these people JobKeeper and JobSeeker. Tenants can't be kicked out of houses. So we basically said let's make a fake market. So because we've got this huge external shock, and now the question is, the idea was you fake it until you can make it, and the question is really, as we're starting to come out of the other side of it, and people start to and you start to see, well, will people have their jobs back or not? And our take at the moment is no, they're not going to have their jobs back. Will we see another round of stimulus that decides to try and fake it for even longer? Yep, possible. Australian government debt levels are pretty low relative to the rest of the world. So, and as we said, to me that's the argument that I'm swayed most of Cameron's is that we have a government that has got low debt levels and wants to support the housing market, and they're all, most of the politicians there have all got lots of houses and negative gearing, so they'll do what they can to try and keep the house prices high. And that's the most realistic expectation I can have for holding the house price up. So without that, I think there's almost no doubt the house prices will fall. I think though the question is really what type of economy we're going to see coming out the other side, and we really can't tell right now. If we came out with today's economy with 19.9% underemployment, so forget the actual unemployment stats, that's the real number. For me, is that you would be it would be a devastating blow on the economy. I do think though, if we get to closer to September and we're still in the same position, that you will see further government support. But it is a question about when does reality start to kick in, and when you start to see if people can't afford it, and we've got these massive amounts of we've lost a lot of demand. We've still got the supply that's still coming on from the build from a few years ago. I'm not a fan of it holding up, but I think Cameron's got some very good points that are right at the margin. I just think those points are overwhelmed by the economic impact, with the one disclaimer that if government throwing money at the problem and changing it and basically trying to fake it for longer, they could probably add another 6 months or 12 months to it if they really wanted to.
Bit of don't fight the Fed, draw government.
yeah, that's right. So, but I think as well as I did mention in the discussion is that there is it's a timing thing though as well. If they wait too late for that, and house prices start falling, then they're not going to. It doesn't matter what stimulus they throw at it. Once people start stepping away and you crack the seal on it, then you will see that big downside to house prices, and then it's not until you reach the bottom that the policies will start coming in. And it is also worth mentioning that we have actually already thrown a lot of policy support at this. So we've already got banks out there lending to people, like following the Royal Commission basically said, you guys are lending to people who you shouldn't be lending to, which is why, and so they had to pull back their lending, which is why house prices fell. And then post the Royal Commission, the federal government said, please get out and lend more money, banks, and get back to lending to people you shouldn't be lending to. So we've already done that. We've already lowered standards. We've lowered interest rates. We've put in first home buyer grants. We already had stamp duty reductions. Not to say they can't do more of them, but all the best policy ideas for trying to prop up the housing market have already been used. Now you've got to get into the next set of ones. So yeah.
Can I also add that I'm also pretty conflicted with this whole thing. Like I'd hate to see the federal government, piss away, tens of billions of dollars on housing stimulus when they could be spent on much better things like proper infrastructure, etc. At the same time, I don't want a housing crash, because given how dependent our economy is on housing, that could literally send us spiraling into a full-blown depression, given how weak the economy is anyway. So, I sort of, in some ways, I sort of hope Cam's right, but I just hope that he's not right, because the government's because we got there by wasting further tens of billions of dollars into sort of unproductive investment. But I certainly don't want to see a monster housing crash, because that would be absolutely detrimental for the economy at this time.
Yeah, well, and as that point as well, it'd be nice to see a housing crash, because that actually fell apart of its own volition, similar to what we saw during the Royal Commission, so that people could actually recognise, hey, there is actually problems with it, we should actually fix it. Whereas if it happens now, the narrative will be everything was fine. As you said, everything was fine. It's all the coronavirus's fault. Let's just go back to the same economy you used to have.
Yeah,
and so we've had
the
RBA warning on that, but obviously politicians.
It'd be nice to be able to go back into a Wayback Machine and come out at 2011 and it never caused a problem in the first place. But unfortunately, here we are.
Very good. Just one final note, actually, and I'm trying to bring out some content just so that people provide it for future shows. But there's a ripper one here from Ryan. So, given all the factors discussed, is the most likely scenario low turnover price stagnation, lower new housing stocks meets lower migration, lower rents meets lower incomes, higher losses for negative gearers carrying forward, and the only real losers being the state government losing stamp duty revenue? An interesting scenario.
Yes, I think that the lower new house stocks. I don't think that's right. Actually, we didn't really move on to that. It was a question I had for Cameron if he does reappear. But the question on that supply demand side is the issue for that for me is that there's 10 million houses out there, Leith? You're going to be right on that. So that's 10 million odd houses out there. You don't actually need very much. So with 10 million houses out there, you don't need very many people deciding to move back with mum and dad, or to get an extra flatmate, or to squish up that little bit to actually really take a lot of demand out of the market. So if we need, say, 100,000 new houses a year, and we've got 10 million, you only need a 1% change in people willing to have an extra person in the house, or move back with mum and dad to actually get rid of all that supply that looks like it's there. Plus, then you go to foreign students, plus the Airbnbs.
Yeah. So, can you guys hear me again?
Yeah, you're back.
Yeah. Well, I'm back.
Back for the second session.
I agree with that. The new supply. Just remember that most developers adjust volumes to more than prices. And there's going to be a lot of small, desperate developers who will sell off their sites and things. But the new housing construction market adjusts through quantities mostly, and so they'll be very patient, very deep pocketed. A lot of the listed guys have recapitalized. So you're right about the margins. It doesn't take many people to move in, but also you can reduce new housing construction, or at least the sale of new houses, by 60% pretty easily, pretty quickly.
Yeah.
And we can be almost certain that the developers will blame the lower volumes on planning rather than the fact that there's less demand in the market. They'll just use it.
Yeah,
that's right. They'll use it as an excuse to get rid of so-called red tape and whatever.
Well, that props up their balance sheet, right? Because they can write up the value of a site on their books and go, no, we'll be fine now. We don't have to sell as many houses. Keep investors happy.
Yeah. Well, there's a question here as well from what you use about if there's fear in the prices are falling, could cutting stamp duty increase the speed of the fall? I'd argue it's the other way around. I'd say people are if you cut stamp duty, that'll get capitalised into house prices. So if I can save 50,000 on stamp duty, then I'll spend 50,000 more on a house, possibly even more, because the 50,000 for the stamp duty has to come up front, whereas the 50,000 for the house I can defray over a longer time period. I don't know whether you can.
I agree.
Yeah,
absolutely.
I mean, that's one thought. I had seen it mentioned somewhere, but it's I think it was a bit of a thought bubble. But that was one that really did toss up to me, is if they did say yes, we're going to use this as an opportunity to finally switch to land taxes, and we'll get rid of all stamp duties, or get rid of 90% of stamp duties, and then gradually work up to land taxes over the next 5 years or something like that. That I think would put a rocket under house prices for a little bit.
And it's something that I'm sure the state governments are considering.
Yes,
definitely. Somewhere when my microphone was having trouble, someone mentioned about the 2022 peak in the late cycle, and I just thought I'd mention that even at the zero lower bound, if that's where we are, all the countries that hit that have also had renewed housing cycles after a few years of adjustment. And
yes.
so I guess my point is, we're all discussing the next downturn, but we're not saying it's a multi-decade crash. Housing will never come back. It's a short planning window of sort of 3 to 5 years where is it, what's going to happen. So we'll hit the lower bound, have an adjustment, but has there been a period where there's never been a next cycle?
No, absolutely not. And I've got some positive. I've got a few other factors that I think that once you go through this period, give it a year, a couple of years, but it could be very easily the Roaring '20s again in terms of I'll go into those at a different stage, but it's an interesting question as well. We never really got into, but and probably haven't got enough time, but I'll throw it quickly to you, Cameron. Is the idea that there's going to be less people that need to work in offices now, or there's a lot more work from home following this, and so whether that means now you can have people living further away, and so it's sort of like the part about is that going to end up people saying, well, I'm going to now spend more money on my house because it's going to be there more, or is it going to end up being, well, I can live further away, and so which of those factors is going to be more important in terms of people, in terms of house prices?
I think both are genuine effects. It's just the scale of how big they are. Like people spending more time at home right now. They're queuing up around Bunnings. IKEA's sold out of office furniture, home office furniture. You can't buy a webcam in the country anymore.
Amen.
People are adjusting to this, but obviously the effect again is heterogeneous, and obviously a lot of organizations have learned it's effective. I've got the right type of staff. We know how to function. This could really work and be a productive, efficient way of doing things. And a lot of organizations are going to realize the opposite. And, who knows how that washes out in the aggregate. I've always worked remotely, but I don't work in the country. I still have to fly to events. I still have to go to events and have good internet and all that sort of stuff. So there's other factors in that mix as well.
Yeah.
But I agree on the Roaring '20s possibility. I think in 12 months' time, I think the uncertainty of this coronavirus and the second wave will have washed through everywhere. And I think the '20s in general, are we going to see the declining unemployment of whatever highs we get to this year? I feel like it's going to be a lot of positive adjustment in the Australian economy, less reliant on minerals and housing and holes. Hopefully, some diversity in manufacturing and other sorts of service activities. I mean, I'm an optimist, maybe.
I think economically it's right. Hard not to. But it's prices though as well. What price you buy at, and that's my main issue with the stock markets is, well, that's already priced in. I'd love to buy in at a price where it's not already priced into the market, because if it doesn't happen, and I think that's especially for the V-shaped recovery, and I think houses are there as well at the moment. Stocks and houses are at the stage where they're priced for a V-shaped recovery.
Yeah, I agree.
If there is a V-shaped recovery, you're basically going nowhere. But if there isn't, you're like, well, there's the downside. And so, and I don't think I think there's a, as you said, if you're coming from a positive side saying it's 50-50, I think it's probably more swayed to not a V-shaped. But even if you're 50-50, you'd say, well, I at least need to take some sort of discount on what I'm paying. So
I think you're right. I don't think we're really going to have any good new information till October, November, December. That couple of months before Christmas, end of the stimulus period, the end of summer in the Northern Hemisphere, the chance for second waves of the virus to wash through and see what sort of political reaction happens. Who knows what the next 6 months or 5 months are in store, but I think after that you can sort of firm up on which one of those is more likely. Would that be your view, Damien?
I think there's definitely there's definitely a range of different outcomes, but it's at the moment I'm keener to look for. I think we're probably a few more years away from the more positive outcomes. I guess I'd like to see. I guess I don't want to get too far ahead of myself. Is that
I mean, timing is everything. You don't want to jump in too soon. I mean, the volatility everywhere at the moment is.
And there's definitely the downside cases are still live. If there's two issues. You've got liquidity and solvency, and we've solved the liquidity issues, and now it's can we work out the solvency issues, and especially the small and medium business market. I still can't see a solution for how you can support the small and medium business market and all the defaults you're going to get there without opening yourself to fraud effectively.
Yeah, well, it's going to be a big adjustment period. Like, certainly it's going to be great for some businesses.
Yes.
Because the spending that we're not spending on travel and all this sort of stuff that we can't do is going to them.
Yes.
But there's a whole suite of others, and I don't know what the proportions are or whatever the case may be, a whole suite of others that have to do something different. Their staff have to do something different. Their building has to be used for something different. Who knows?
Yes. And it's that
who
adjustment.
knows?
Yeah. Where you say,
And how many need to adjust all at once? That's the economic conundrum, I guess, we have to wait for. Huh?
Yes, exactly. So you say, well, maybe structurally we need 30% fewer people in our tourism sector. And so, yeah, they'll find new jobs, but it's a question of where that'll be and how long it'll take them, and new sectors, how long it'll take for new sectors to pop up.
Yeah, I guess I'm an optimist there. I feel like a 2020 economy can be surprisingly quick. I know after the mining boom or during the mining boom up here, I had mates switching from IT to pouring concrete and back to something else, like pretty routinely. And who knows? I mean, so the service sector is a little bit different. You know, you got to see what sort of demand is there. Very easy to funnel people into basic construction.
Yeah, and that's the problem with this unknown period, isn't it? Because you've sort of basically taken a whole bunch of say restaurant workers. So people are going to switch much more to takeaway, and so you don't need as many wait staff, and you know maybe there's a 20% cut in that. But if you're a waiter at the moment waiting for your job to come, you're a JobKeeper waiting to go back, you might not be looking for another role yet. So yes,
yeah, I mean those types of jobs are much more flexible, right? You can easily do something else in another industry. The question is the pickup in demand of those other areas going to absorb them? How long does all that adjustment take?
Yep.
Because it's all happening at the same time.
Yes.
Very good.
Anyway, it's going to be an interesting year. We can count on that for sure.
Will certainly be. So, look, thanks for your time today. We've gone. It's been a very full podcast. Let's put it that way, Cameron. Would you mind just sharing with our listeners how they can get in touch with you? Obviously, you're a friend of the show and been on many times, but there may be some new listeners recently.
Yeah, great. So Twitter, I'm on pretty regularly at Dr. Cameron Murray. My website is fresheconomicthinking.com. I have a Facebook page, Fresh Economic Thinking, as well, and that's where you can keep track of my work.
Lovely. All right. Well, look, thanks very much for sticking around for an hour and a half and sharing your viewpoint on the bull case for Australian property, mate. Really appreciated that one. We'll say goodbye to Leith as well. See you, Leith. Well done on...
Yeah, catch you later, guys. Thank you for listening, everyone, and sticking with us. Speak to you next time.
And I'll just commend you on your interface with your neighbours as well, mate. That's fantastic. You see, you got... I was very impressed with the amount of interface you've got with your neighbours. You're leaving a lot of us for dead. And thanks again, Damien, for your time as well and thoughts.
Yeah, I have no idea whether my neighbours have lost their jobs or not.
Anyway,
thanks, guys.
I'm a family guy.
Excellent, lovely. Next week, so as followers of the show would know, we did a show on debt deflation, just covering off on some of Ray Dalio's thoughts on debt deflation. Anyway, we had a call from another friend of the show, Jonathan Rockford, who works in the distressed debt space, and he proposes that, puts forward a very strong Ray is wrong theory. So we're going to get him up on the show next week. So that's Thursday, the 28th of May. At 12:30, of course, head on over to our Nucleus Wealth live webinar to potentially have another debate on whether or not Ray Dalio's thoughts on debt deflation are true or perhaps need a little bit of adjustment with Jonathan. So on that note, thanks for sticking around, and we'll look forward to catching you then. Cheers. Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return we'll send you a weekly email with new webinar topics, links for our podcasts and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers.